Hello everyone, welcome back to the Road to Retiring channel. I hope you are doing well. Today I want to speak a bit about the vertical farming industry, as this is something I've spoken about before on this channel and I find the industry quite fascinating. Now, Appharvest released their earnings yesterday, so we are going to get into that in a bit, but for those who don't know, this is what the role of vertical farming is and why it's so interesting. So what it does, it requires less water. Agriculture is the world's largest freshwater consumer, accounting for 70 to 80% of global freshwater withdrawals, and vertical farming actually manages to reduce this water consumption by around 90% in Appharvest case, and they're saying 95% and in some cases 99% for other cases. So super beneficial in terms of how we can reduce our water usage, and it requires so much less land because you're able to plant these crops vertically, and instead of planting them sort of in the ground, obviously you have so much more land space available to you. And this is so good because it's estimated that almost 80% of global deforestation is caused by agricultural production, which is also the leading cause of habitat loss. So it's just a massive industry for the environment and could have such beneficial impacts. Also, it removes the need for long-term transportation of produce, because you're able to have these locations in factories and warehouses that are in urban areas and in central areas. You can get the produce out to consumers in super quick times without having to go across borders and things like that. But this just keeps all the produce really fresh by the time it arrives at the companies that are then going to sell this to consumers. So I think this is super interesting, and there's a lot of potential here, and I want to go into a little bit about what Appharvest say. So they're saying it's investing in the future of food. So they're a sustainable food company developing and operating some of the world's largest high-tech indoor farms with robotics and artificial intelligence, so really sort of on trend at the moment with the use of AI. They are building a reliable, climate resilient food system, and they're designed to grow this produce with up to 90% less water than open field growing. And what I think is really interesting is it's while producing yields up to 30 times that of traditional agriculture. There's just massive potential here, but the issue is, obviously with the use of high-tech indoor farms with robotics and artificial intelligence, right now a lot of these companies are struggling to become profitable, and that is the main issue with these, and they are really high risk. They're all really small market cap. There's not much sort of value to these stocks at the moment. They're all pretty much around $1. They're nothing expensive, and yeah, they're super high potential, but at the same time they're all really struggling to become profitable because of this use of high-tech indoor farms. I want to go over a little bit about what their farms are. They have this 60-acre tomato farm in Moorhead, and they have an additional 60-acre tomato farm in Richmond. They also have salad greens farm and a berry farm for strawberries and things like that. And as they say again, how it's sort of similar to what we spoke about before, central to their mission is they're within a day's drive of 70% of the US population, and this prioritize of direct shipping can reduce transportation fuel by up to 80% compared to produce from Mexico or the US Southwest, and it means that their produce is picked riper and delivered to stores within a really quick time. So as I say, it's all just really fresh when it gets to the stores, which I think is a massive benefit. So let's go into a little bit about what Appharvest has said. They're announcing the 2022 quarter 4 and full year results, and they say they achieved a net sales guidance of 14.6 million, which is an increase of 60% year over year. They also managed to expand to their 4-farm network, which they put a lot of investment into, as before they only had this Moorhead farm, whereas now they've got all 4 of these farms that they are expanding into. So they are still growing their business in terms of what they're looking to produce, and we are expecting a massive increase in sales in the coming years. So going over a bit about what they've mentioned in here, which I think is interesting, you can see that this is their full year 2022 results, and yes, they achieved their guidance, delivering a net sales of 14.6 million compared to 9.1 million for the prior year, which is a 60% increase. And they're saying that this was driven by a combination of higher market prices for tomatoes and the addition of new sales of higher priced tomato varieties, strawberries and salad greens in the fourth quarter. So it'll be interesting to see how that pushes on next year, as this was just a fourth quarter thing, and if it's across the whole year, then this might have a really nice benefit to the sales outlook for next year. Now, what I think isn't so good when we look at this is obviously the net loss, $176.6 million compared to a net loss of $166.2 million for the prior year. Now this is a massive alarm bell to me, because you want to see them becoming closer to profitable, and they're getting further away. That's 10 million larger loss than they had the previous year, so that's definitely not a good sign. But they do say that this increase in net loss was driven by production ramp up at the 3 new farms. So now that they have these 3 new farms set up, it'll be interesting how this plays out next year. They're saying they achieved their non-GAAP adjusted EBITDA loss within its revised guidance, and this adjusted EBITDA loss of 72 million versus a prior outlook in the range of 67 to 72 million. So it's at the top end of that loss, which isn't great again. But let's go into a bit of what their Appharvest farm network is. So yes, they delivered on their commitment to quadruple the farm network. They brought in the 3 new high-tech indoor farms and diversified their crop portfolio, which now includes strawberries, cucumbers, salad greens, and more tomatoes. So it's just an additional types of tomatoes that they didn't have previously. But one thing that I think is really interesting in this earnings report is that in January of 2023, so really recently, they've actually appointed a new board member as their chief operating officer. And I quite like what I'm seeing here, because it's saying they're working to optimize production, revenue, and costs across the Appharvest 4-farm network. But the company's strategic program is now focused on profitability. And this is what I really want to see, because they're getting further away from becoming profitable in terms of their net loss this year compared to last year. And we really need to see them start to move towards profitability before Appharvest becomes a massively interesting stock to follow. And yeah, they're expecting operations in the first quarter of 2023 to ramp up as expected. They're opening their new farm on a phased approach, and the company anticipates the third 5-acre salad greens growing area to be planted late first quarter of 2023. So things are kicking off further in 2023. And if we look at the financial outlook down here, they're saying they remain confident in the ability to be self-sufficient and to generate positive operating cash flow over the longer term. So that's good that they are still positive about becoming positive in terms of their operating cash flow. So that's really good to see. And with the first quarter of 2023 marking the first time that all 4 facilities will be shipping commercially to top national grocery store chains, I think hopefully we start to see sales fly. And they're saying that the company expects to see significant year-over-year sales throughout 2023, and even more so in 2024, with them anticipating full year 2023 guidance of net sales to be in the range of 40 to 50 million, and non-GAAP adjusted EBITDA loss to be in the range of 67 to 76 million. So there's good and bad here. Really nice growth in 2023, and they said they're expecting even more growth in 2024. So to 40 million from what was 14 million this year, if we go back to the top, 14.6 million net sales, nearly a 200% increase up to, if they do hit 50 million, which they're saying that they could be in that range. But that non-GAAP adjusted EBITDA loss in the range of 67 to 76 million is pretty much in line with what they had this year. You can see their full year 2022, their EBITDA loss, non-GAAP adjusted EBITDA loss, was 72 million. So they're expecting this to basically be the same next year. Again, not getting really any closer to that profitability we'd like to see. And so I still would probably want to wait a little bit before getting into this. But if they are able to increase sales like this and then cut out some of the expenses, then it could become really, really interesting. And so I want to touch on what the company's value could be. So I've gone for Appharvest. We are using the price to sales ratio here only because they're obviously not profitable. And you can see based on this, on launch, the price to sales ratio is the best one to use until they become profitable and break even. And then you can start focusing on price to gross profit, price to earnings, price to operational cash flow, things like that. But we're going to focus on price to sales here. Now the market price is 0.78, shares outstanding is 108 million, discount rate I've gone for my standard 9.5%, I've gone for a super high margin of safety at 40%, with super high share dilution at 20%. Now I've gone for this 20%, they haven't increased their shares dilution too much in recent years. This current's actually wrong, it's 108 million, which I can show in here, based on shares outstanding. you can see a weighted average common shares outstanding 108 million, so it is 108 million, and you can see that's what it says for Q4 2022. I'm not sure why it's showing 147 million here as the current on TradingView. As you see, from 2021 Q2 until now, this has only increased from 100 million to 108 million, so it's not massive share dilution. But if you look prior to that in 2020, it did jump up from 44 million in 2020. So that is a massive amount of share dilution from 2020 to 2021. And even though this has slowed down, I want to account for the fact that it's a possibility that they could dilute the shares some more. Also, one thing I want to touch on is the balance sheet is actually quite good. Their total assets are around 260 million higher than their total liabilities right now. We look quarterly, you can see that they haven't reported the liabilities for Q4 of 2022, but the equity has been reported at 260 million. And if you open up the liabilities, it does show you things like the long-term debt currently at 286 million. So yeah, the outlook in terms of the balance sheet is not so bad. The equity is good at 260 million, and the book value is really interesting. I want to go into the statistics here and scroll down to some of their ratios because it's really, really quite good. The quick ratio is good at 1.96, the current ratio is good at 2.3, inventory turnover solid, but down here the solvency ratios, you can see debt to assets really nice, debt to equity really nice, and in terms of long-term debt to total assets and total equity, they're not really in any trouble here, so I think this is all really good. And here, the price to book ratio, I think this is where the company becomes really interesting, because currently the price to book ratio is 0.25. Now what that means is if it shows how much value is in the company relative to the share price, and it's the sum of all the company parts if it were to be liquidated today. If you were to liquidate the company completely and just sell off what the company's worth fully liquidated, then this would sell for 4 times higher than the current share price would suggest. So there's definitely some potential value here based on the price to book ratio. As I say, we just need to see this earnings starting to become profitable. I think that TradingView is being very, very generous by expecting it to climb quite like this, because we just seen the adjusted EBITDA net loss for next year is basically the same as 2022. So I wouldn't expect it to reduce quite like this in 2023. Now, going over a bit more of what our prices we've used, I've gone for that as say 20% share dilution, 40% margin of safety. I want it to be really safe with any sort of predictions I make here, and you can never be too safe with this, and it could easily fall further. Now the revenue, 14.6 million for 2022, and I've gone with a price to sales multiple of 2.5. Now this is really low if you look at how it's been historically. If we look over quarterly, the price to sales ratio, this has just been falling, and this is why I've gone for super low 2.5, because I don't want to go for an average, because it's very consistently falling from 300 to 100 to 43 to 45 to 15 to currently where it sits at 6.4. So I've anticipated that to keep falling, and I've gone for 2.5 as a price to sales ratio. But this is not because the sales haven't been climbing. This is because the vertical farming industry was something that stock investors were really interested in a while ago, around when it was trading at $36, and you can now see it's trading at $0.78, with the pre-market going up to 0.85. So there's actually been quite a bit of a jump in the pre-market. This isn't just Appharvest. You can see for Hydrophone, this is the same. All of these vertical farming industry sort of stocks, $92 down to $1.55. Village Farms International, $17 down to less than $1. All of these have had this similar outlook because there was a massive boom around the industry, and then it found out, oh, none of these companies are close to becoming profitable. So that's the sort of issue with the industry, and that's why I set this massive margin of safety. I've gone for this quite safe price over sales multiple, and I've not put revenue growth in here. I've just put what I've sort of expected. They said they expect 40 to 50 billion in 2023, so I've gone for the low range of this, and they said they expect this rate to increase by even further in 2024, so I've gone for 100, with then a slowing growth rate coming in 2025 at 140. And based on this and a price to sales multiple of 2.5, even with the 40% margin of safety and 20% share dilution, the fair value would be 0.86 and the 2025 price would be 1.87. Now, if we were to reduce the share dilution to only 5%, then that jumps up to a fair value of $1.28, even though it's 0.78 right now. So there'll be nice upside on that with a really good 2025 price of $2.80. And if we were to say reduce the margin of safety, well, then that just brings the fair value up to $1.70. But I feel like you need to be really safe with something like this. And look, it's something you could buy, and there's potential here. It could be a great investment, but equally, it could be absolutely terrible. They're no close to becoming profitable, and they're no closer, to becoming profitable, and we could easily see the company just fall away because they can't turn any profits, and eventually just all your shares fall to $0. So with a company like this, it's a massive gamble, but I do think it's an interesting one and potentially at a nice price right now, and a gamble that you might be interested in making compared to when it was at these valuations at 36. Obviously this is just ridiculous, but I think at the current valuations it's more interesting that with a price to sales multiple of just 2.5 and growth which is pretty much in line with their expectations, it becomes around the fair value. So let's see if they can meet some of these expectations. I'm going to keep an eye on it moving forward. I know this was a bit longer of a video, but I wanted to do that deep dive on Appharvest. I hope you enjoyed the video. If you did, please drop it a like, subscribe, and leave a comment down below for any other stocks you're interested in hearing about. Bye guys.